Okay, so briefly, let's talk about introduction to capital budgeting. What is capital budgeting? All right. Capital budgeting is also known as capital investment decision, investment appraisal, or capital expenditure. Okay. It involves the process by which an organization commits its funds into long-term projects. When you say long-term projects, the long-term projects are projects that span over one accounting periods. That is more than 12 months. Any project that will last for more than 12 months is what is referred to as capital budgets or capital expenditure. Examples include construction of roads, dams, bridges, refineries, office building, or owner-occupier building. All right. So you can see that any of these projects that I mentioned will last for more than 1 year to complete. And that is what is referred to as a capital budget. All right. So it is expected that management of a company will commit the limited scarce financial resources of the company into any project that will increase the value of the company and which will invariably maximize the wealth of the owners. All right. Because the financial resources is not sufficient. And then every management of a company are engaged in order to create value for the business. So it is expected that using relevant investment appraisal technique that is consistent with the government, with the company's policy or capital budgeting guideline, then of course it's expected that the company will invest in any project that is financially viable. Okay, because any project that is viable will certainly increase the value of the company. Okay, now what are the characteristics of capital budgeting? There are about 6 different steps involved in capital budgeting. There are 6 procedures involved in capital budgeting. One is the identification of viable investment opportunity, okay, or what we call investment portfolio, okay. Now, let me briefly explain this procedure. There are some department within an organization. It could be marketing departments, it could be research and development, it could be business service unit of the organization. Okay, they are responsible to scan the business environments to be able to identify investable opportunities. All right. So there are different activities that we go into doing that, but I don't want to go too much into details to save time. All right. So what the first procedure is talking about is that when there is need for an investment or there is need to undertake a project, the first thing that the company will need to do is to identify to identify possible or potential projects that the company can commit its limited scarce financial resources on. All right, so that's the first procedure. First, the responsible person within the department, whether it is marketing department, whether it's R&D department, we need to get back to the management to provide explanation on the outcome of their findings. All right, we need to let management understand what the upshots of the investigation or of the project that have been so identified. All right, of course there will be a physical meeting, management meeting, and at the same time that should be documented with a memo. All right, it should be documented with a memo. So in that meeting, another department will be asked to go and appraise the project that have been identified, which is, of course, the finance department will have to go and evaluate what the financial viability of the project. So which will take us to step 2, which step 2 is evaluation of projects. Okay, evaluation of projects. Now, this is where you have responsibility as a finance person. All right. The responsible person within the organization could be finance director, finance manager, finance supervisor, okay? whatever the head of that department, the title of the head of that department. So he will be the one responsible for the evaluation of the project with other team members. All right. So using relevant investment appraisal technique that is consistent with the government capital budgeting guideline. All right. So if whether the project is financially viable or not, the finance director will need to get back to the management. Okay, there will be management meeting that will be convened for that matter to discuss the outcome of that analysis. Okay, whether it is good to go or not viable, management must be aware. However, after that, there will be a meeting also to communicate the analysis and to review the report, and then and in that meeting, there will be an approval. Okay, there will be authorization and approval of the project if the project is financially viable. Because if the project is financially viable, the finance director will need to give it a go ahead as an expert. Okay, endowed with the requisite knowledge and exposure in that regard. We need to get back to them and advise. We need to advise the management that the project is financially viable, and then the company can commit the financial resources to embark on the project. So since the project is financially viable, then management will need to authorize for expenditure. We need to authorize and approve that the project should be carried on. The project should be executed. So since there's authorization and approval of project, then the next thing will be to start developing and executing the project. Okay, so that will be the fourth procedure is developing and execution of a project. Okay, since there is a management approval, at this step 4, there will be need to mobilize people and equipment to sites. There are so many things that will go into from step 1 to step 4. There are so many activities that will be going on in the background, because of course, depending on the size of the organization, it is expected that an ideal organization, especially a large one for that matter, will have different kinds of committee in relation to capital budget. There will be bid committee, whereby different contractors will need to submit their bid or quotation to quote for the project. And at the end of the day, a successful contractor will be selected, which of course it is that successful contractor that will be given the job to undertake. Again, this also depends on the policy of the company. It may well be that the company may want to adopt a single sourcing kind of a contract, such that only one person will just bid for the job. But ideally, it is expected that different contractors will bid for the job, so that we'll be able to select the best among the best. All right, and then to ensure that the financial resources of the company is judiciously utilized. So, like I said, from step 1 to step 4, there are so many activities that will be going on at the background to ensure that the right person and the most qualified person is given the job. Of course, before the contractor will mobilize to site, before the contractor will mobilize people and equipment to site, there will be contract agreements to be executed between the two parties, the company and then the contractor, expressly stating the responsibility of both parties, and whatever that is in the contract is binding between the two parties. All right. So, of course, after the developing and execution of the projects, there will be need to monitor and control the activity of the people and equipment on site. Not only that, the company also needs to monitor and control costs. So in monitoring the activity of the people and equipment on site, this is very important, because the reputation of the company is on the line. Therefore, the company must ensure that there is no incidents on site, must ensure that the right the right people and the most qualified people are on site to monitor the activity of the contractors and the personnel, because in order to avoid any incident or any fatality that may arise, because any construction activity, you need to take into consideration the safety of the people and equipment, as well as the security of all the people you have there. So And it is expected that at this stage, the company will have its own people on site to monitor the activity of the people and the contractor, because contractor may want to, an average contractor will want to follow shortcuts, because in order to maximize his own margin. So the contractor may not want to do the right thing. All right. So whatever the contractor has quoted that they are going to do, you must ensure that the right quality and quantity of material are used at all time. And that's why it is important for the company to have his own representative on site, his own engineers, his own QS, quantity surveyor, okay, different kinds of engineer or personnel that will be there to monitor the activities of the contractor, because the company wants to ensure that he's doing the right thing. Because some time ago, something happened in Lagos, here in Lagos, whereby a 21-story building collapsed, an uncompleted building for that matter, the building under construction collapsed on the people, on the workers, as well as the owner of the property, sometime around 2022, I think February 2022, we call it Ikoyi Gates. All right, just this almost the same, almost 3 years now. Yeah, it's about 3 years now. So it was the same February of 2020. We are in February now, when the incident happened. Why did the building collapse? The information we gathered was that, okay, Lagos State government gave an approval for 15th floor, and the owner of the property tried to cut corners, get some unscrupulous personnel of the agency that are in charge of building and in Lagos State, to get additional 6 and increase the floor by additional 6, making 21. So the building was extended from 15th floor, approved 15th floor, to additional 6 floors, making 21. And because the building cannot, the topography of the land cannot accommodate that heavy, and the capacity could not withstand the load, and the building gave in. And in fact, almost about 50 people or thereabout, including NYC coppers, and then the friend of the owner of the property that was on his way to airport, because the guy lived in abroad, so he was already on his way. Let me just say hello to my friend, and where they were talking, the building collapsed on them. It was a very sad incident. So you can imagine, if the owner of that property were to be alive today, what could have happened? How is it going to be able to face the government and also face the investors? Not only that, the people that lost their lives, how will the owner of the property be able to face all of those, the guilt that, oh, these people died because of my action or inaction, So that is what we are talking about. And that's why it is important, as a responsible organization, when you are carrying out capital budgeting activities, you must ensure that the right quality and quantity of materials are used always. Some contractor may, because they want to increase their margin, they may choose to go and they may choose to buy substandard, or they may choose to use a substandard material, and that's why it is important that you need to, as a company, you have your own people on site to monitor the activities of the contractors. Not only that, the company will also need to monitor costs, because the financial resources is not sufficient. It's not always sufficient. So you need to ensure that the little that you have, you maximize it. So you need to control your budget. This is also where you have the responsibility as a finance person. All right. So to monitor the actual spend versus what has been budgeted for. All right. If there is need for additional spend, then management must be aware. And that's why on a regular basis, especially on a monthly basis, there must be stewardship reporting to the management, so that management is aware of the project status. All right. So what is the condition of the project as of today, so that you don't give any unexpected, you don't go back to management when there's an emergency, just because, you fail to monitor your costs. Then all of a sudden you now realize that you almost you almost exhaust the budget, then you're now seeking for additional funds. It doesn't work that way. You can't just, there must be adequate monitoring and control of the costs to ensure that on a regular basis, you update the management on the status. It may well be that, okay, if you are going to need additional funds, all right, it may well be that you are going to need a higher level of approval for you to be able to get the additional funds. And that's why management must be informed at the right time. So especially on a monthly basis on the project status. All right. So if you want to seek for additional funds, why do you want to seek for why do you need additional funds? It may well be there's a change in scope. All right, maybe something that is not within the budget before. Now it has been included. So that will also involve additional costs that will be spent. It may well be if there's another change in scope, there could be something that has been included in the contract before. Now there's no need for it again. So you want to remove it. That will save money because if you have to monitor your budget versus your spend. If your budget is, if your spend is lower than your budget, why are you spending lower than the budget? If your spend is higher than the budget, why are you spending above your budget? There must be justification for any variance achieved during the course of the project. So it may well be that there's an extension of time as well. Because anytime there's an extension of time, there's likelihood for additional funds, additional spend, okay, to be incurred. So all of these things, and that's why as a finance person, you must work hand in hand with all the project team, all right? The project manager, the project coordinator, the project execution manager, whatever all the project team, including the procurement, you need to work with them so that you have up-to-date information on the project. As a finance person or as a finance director or finance team member, you don't work directly on the field. You don't work on site. So your job remains in the office, but you must work with those people for you to get the first-hand information so that you'll be able to speak through the numbers. It's not just about you being recording and projecting the project status. You must be able to speak through the numbers, working with the project engineers to have up-to-date information so that you can speak through the numbers. All right. So that will make it to be more relevant rather than just be talking about number without knowing the project status. So that will not be good enough. From time to time, maybe once in a week or once in 2 weeks or even once in a month, as a finance person, you need to go to the site to talk to the project team that you would like to be on the site to go and check the project status or the project progress, okay, to see what is where the monies are going to. So you'll be able to have at least first-hand experience of what is happening on site. So that's basically what step 5 is talking about under monitoring and controlling of projects. Then the last one is post-investigation, post-completion investigation. So the post-completion investigation is talking about the fact that the company wants to ensure that the objective at which the project is being executed has been achieved. It may well be that during the course of developing the projects, there are issues here and there are defects. So there will be need to call the contractor to come and fix whatever the area of concern is, all right? And that's why it is important whenever a company wants to embark on capital budgeting activity in the contracts, there will be need to insert what is called a retention fee in the contract, such that a retention fee is a small amount, percentage of the contract price that will be retained until the company is satisfied that the job is well done. It may be 6 months after the project has been completed. It may be a year. It may be 2 years, depending on the agreement between the two parties, between the company and the contractor. So, of course, that will represent a liability to the company, all right? But that notwithstanding, because if you have given the contractor 100% of the contract price, and then after the completion of the project, you now realize that there's a defect somewhere, there will be no motivation for the contractor to come on time. Even if the contractor will come, it may delay. And that's why it's important to retain that sum. Because once the contractor is aware that you still have some change or some balance to collect from the company, anytime the company call on the contractor, you will want to it will come swiftly to come and resolve whatever the issue is. And then again, of course, during the course of the project, there will be lessons learned. All right, there will be mistakes here and there. So these mistakes, these lessons learned is expected to be documented. All right, it's expected to be documented so that when the company wants to execute such a project in the or similar project in the future, uh, we can revert to the lessons learned, because every organization is in a learning process. Okay, every organization is in a learning process. So documenting the events or the mistakes and how the issues were resolved will certainly aid organization learning. All right, it will aid organization learning. It may well be that even the manager that executed the project is no more with the company, but if the issues are documented, certainly the incoming manager will be able to check through to see what was the issue and how they were able to resolve it, so that you don't repeat similar mistake in the future. That is essence of a post-completion audit or investigation. Okay, so that is about the procedures involved in capital budgeting decision. So I will not talk about characteristics. So it's something you can read on your own. So let's talk about um, methods of project evaluation. Okay, methods of project evaluation. Basically, there are two methods of project evaluation. One is discounted cash flow method, then two, non-discounted cash flow method. So what do you mean by discounted cash flow method? The discounted cash flow method is a method that takes into consideration the timing of cash flow and the time value of money. Okay? The time value of money suggests that the value of 1 naira of today is worth more than the value of 1 naira of tomorrow due to price level changes, that is inflation, and then the investors' preference to have their benefits now rather than keeping it into the future. All right. So that is what the uh, time value of money is talking about. What are the techniques under the discounted cash flow method? There are about 6 or 7 of them. One is the net present value. One technique under discounted cash flow method is net present value. 2 is internal rate of return. 3 is modified internal rate of return. 4 is project duration. Okay, let me put it here. Project duration. Then, yes, 4, discounted payback period. 5 is adjusted present value, profitability index, net terminal value, benefit cost ratio. Okay, benefits. Let me write that. Benefits cost ratio. Okay, so these are some of the techniques under the discounted cash flow method. So let's talk about the non-discounted cash flow method. The non-discounted cash flow method is also known as traditional or conventional method of investment appraisal. Is a method that does not take into consideration the timing of cash flow and the time value of money. The techniques under the non-discounted cash flow method include the payback period and then the accounting rate of return. So we are going to pick it one by one. What do you understand by net present value? What is net present value? The net present value represents the difference between the present value of cash inflow and the present value of cash outflow in capital investments. All right. So again, like I mentioned earlier, you've done this under performance management. So I just want to brief you to add 1 or 2 things so that we can go as fast as possible. All right. So just as a refresher, I can't just say because you have learned, you have done it previously and I skip it. No. I won't feel, I will be very incomplete within myself. So it's better for me to just run you through. Okay. So like I said, the net present value represents the difference between the present value of cash inflow and the present value of cash outflow in capital investments. Okay. The NPV is adjudged to be the overall investment appraisal techniques because it's a measure of absolute profitability, and then an NPV is considered is a technique that is consistent with the shareholders' wealth maximization objective. Okay, NPV is a technique that is consistent with the shareholders' wealth maximization objective, and that's why it's considered to be the overall investment appraisal technique in theory. Okay, all right. Of course, the examiner cannot be asking you at this level what is advantages and disadvantages of NPV. So you are beyond. That one is below your standard. Okay. Then let's talk about how to calculate NPV, calculating net present value. Calculating net present value. NPV can be computed using either formula or you use the tabular method. So far, so good. Under cost of capital, we have calculated the NPV, especially under the redeemable preference share and the redeemable debt. We calculated NPV. Okay. So using the tabular method, this is the format to calculate the NPV. All right. Of course, we create a column for number of years, useful life of the project, description of item, if necessary. We create a column for cash flow, discount factor, then the present value. And we say that NPV is the present value of cash inflow and present value of cash outflow. That is, first thing first, whenever you want to compute your NPV, you must add together the positive present value. You add up the positive present value, you net off the negative present value. The difference will give you NPV. But if you start from negative present value, certainly you may have a wrong interpretation, because right now as it is, if I say 1,000 minus 1,008, I can say minus 8. That would be a wrong interpretation. That's why it is important whenever you are calculating NPV, you must start from the positive present value. You add up the positive present value before the negative one. All right. So the difference will give you the NPV. So if I don't want to use formula, if I don't want to use tabular method to compute my NPV, I can as well use tabular method. I can as well use a formula, and I will get the same answer. Okay, using formula calculating NPV, you can say NPV is calculated as depending on the useful life of the project. Say for example, this project, I don't know, but you can say cash flow of the first year divided by discount factor of the first year plus cash flow of the second year divided by discount factor of the second year, on and on until you get to the final year. So cash flow of the final year divided by discount factor of the final year. You add up all of this, this will give you the present value of cash inflow minus the present value of cash outflow. CO means present value of cash outflow. So the difference between the two will then give you the NPV. So using formula, calculating NPV using formula, this is what you are supposed to do. Okay. Now, what is the decision rule under NPV? For independent projects, accept if NPV is positive. Once your NPV is positive, that means the project is financially viable and should be undertaken. Of course, you should know that once it is negative, then the project should not be accepted. What if there is zero NPV? Then, of course, the project can be accepted or rejected depending on other qualitative factors. That is for independent projects. Again, for mutually exclusive projects, you need to accept any project with a higher positive NPV. Any project that produces a higher positive NPV should be accepted. So what do you mean by, before we move to internal rate of return? All right. So that's basically what NPV is all about. All right. That's basically what NPV is all about. So before we move to internal rate of return, here I mentioned independent projects. I also mentioned mutually exclusive projects. So you need to know at this level, you need to know what is independent project, what is mutually exclusive project. Examiner can ask you. So let me put it down for you. What do you mean by independent project? Independent project is a standalone project. Let me put it there. Independent project is a standalone project that may be accepted, that may be accepted or rejected based on his own merits, own merits. That is, or for example, if the project produces a positive NPV, it will be accepted. But if negative NPV, it will be rejected. So that is what is called an independent project. That is what is called independent project. It's a standalone project. Once the project is positive, with the project has a positive NPV, for example, you say it is good to go. So that is basically what independent project is all about. Then what do you mean by mutually exclusive projects? Okay, let me see if I can get a space here. Let me see if I can manage this one. All right. So for mutually exclusive projects, mutually exclusive projects, mutually exclusive projects are competing projects. Competing projects in which the acceptance of one will preclude the acceptance let me write that of the other. For example, where project A and B, because examiner can ask you to explain independent project and a mutually exclusive project, you must be able to give examples. It's not sufficient for you to just explain without giving an example. For example, where projects A and B are mutually exclusive. Where projects A and B are mutually exclusive. The acceptance of project A will mean the rejection of project B and vice versa. Okay, so mutually exclusive projects are projects that cannot be accepted together. All right. Okay, so that is for that. I do not get space to write the remaining ones. So that's it. So now that you know what independent projects and mutually exclusive projects are, So let's move to internal rate of return. What do you understand by internal rate of return? The internal rate of return is also known as break-even rate of return, yield to maturity, market discount rates, market yield, rate of return. All right. So it's the rates that equate the present value of expected future cash flow to zero. That is, what that simply means is that any rate of return or any discount rate that is used to compute NPV and produces a zero NPV, then that rate is the internal rate of return. And that's why it is called break-even rate of return. So the internal rate of return is computed using trial and error method. Okay, the internal rate of return is computed using trial and error method. Basically, whenever you want to compute IRR, you need about 3 procedures to be carried out. One is to assume 2 discount rates that will produce 2 opposing NPV. That is, a positive NPV and a negative NPV. Then step 2, you compute internal rate of return using the internal rate of return formula. Okay, you use the internal rate of return formula. We use this formula when we are doing the cost of capital. All right. Then step 3, you then advise on the acceptability of the project. So that will take us to decision rule under internal rate of return. Again, for independent projects, accept if IRR is greater than the company cost of capital. Accept if IRR is greater than the company cost of capital. That is the decision rule for independent projects. For mutually exclusive projects, accept any project with a higher IRR, provided it is greater than the company cost of capital. So that's the decision rule for mutually exclusive projects. Now, it is possible that the decision of NPV may be conflicting with the decision of internal rate of return. And this is an examinable area. Examiner can ask you to explain why is the decision of NPV conflicting with the decision of internal rate of return. What are the causes of the conflicts? Examiner can ask you. Therefore, when there are mutually exclusive projects, okay, when there are mutually exclusive projects, the decision of NPV may be conflicting with the decision of internal rate of return, because when there's independent projects, the decision of NPV will be the same thing as the decision of internal rate of return. They are not going to go against each other. Whatever the decision of NPV is the same thing that internal rate of return will suggest. But when there are mutually exclusive projects, then the decision of NPV may be different from the decision of internal rate of return, because NPV may suggest a particular project for acceptability, then internal rate of return may favor another project. All right, so this is an apparent conflict. So what are the causes of conflict? There are 3 major conflicts between decision of NPV and then internal rate of return. Let me use hypothetical numbers to explain the causes. Okay, the causes of conflicts between NPV and then internal rate of return. Let me use hypothetical numbers to explain it. All right. Say, for example, you have project A, you also have project B. Okay. So maybe you have discount factor here at 10%. Let's use that. So the initial outlay of project A is 500 million. Project B is 800 million. Of course, discount factor at year 0 will generally be equal to 1. So the useful life of project A, say, is 3 years. Useful life for project B, say, is 5 years. So cash inflow of project A for the first year, say, is 300 million. In year 2, 250. Year 3, 150. Of course, project A has 3 years life. Project B has 100 million, generates 100 million in the first year, 180 million in the second year, 250 in the third year, 300 in the fourth year, and then 320 in the fifth year. So these are the cash flows associated with projects A and B. And you know, discount factor at 10% for year 1 is 0.909, 0.826, 0.751, 0.683, and 0.621. Okay. Please, just give me 1 minute. Okay. So now let's explain. Let's go back to the causes of conflict between NPV and then the internal rate of return. The first reasons for conflict is when there is significant difference in the amount of capital outlay. Okay, when there's significant difference in the amount of capital outlay. What do I mean by that? When you look at our hypothetical figures, you will notice that in year 0, where you have the initial outlay of project A is 500 million, while that of project B is 800 million. So you can see the 300,000 difference is very significant. So when there's a significant difference in the amount of capital outlay, then the decision of NPV may be different from the decision of internal rate of return. So that is what I mean by the first one, that is significant difference in the amount of capital outlay. Then number 2, problem of difference in patterns of cash flows, all right? Problem of difference in patterns of cash inflows. When you look at project A, you will notice that project A generated a higher cash flow at the beginning, at the earlier part of the project. And in the latter parts, the project generates a lower cash inflow. Relative to project B generated a lower cash inflow at the earlier part, but in the latter part, it started generating a higher cash inflow. And you know that discount factor at the earlier part is always higher than the discount factor at the latter part of a project. Therefore, any project that has a huge cash flows at the beginning or at the earlier part of the project may be favored over the other project. So when there is difference in the pattern of cash inflows, then this may result into conflicts between decision of NPV and then the decision of internal rate of return. The third area of the reasons or causes of conflict between NPV and internal rate of return is difference in useful life, all right? Difference in project useful life or project sizes or project life, all right? When you look at the hypothetical number, you notice that project A has 3 years life, whereas project B has 5 years life. Project B has opportunity to recoup additional cash inflow for 2 years relative to project A. So in this circumstance, project B may be favored over project A, all right? And that's why there's always a conflict between NPV as well as the internal rate of return. So these are some of the key causes or reasons for conflict between NPV and then the internal rate of return, all right? So just read through all of this, and then you can use those hypothetical figures that are used for my explanation so that I'll be able to gain more insights. Now, Examiner can ask you, how do you resolve the conflict between NPV and then the internal rate of return? So when there's a decision to be made, all right, on the acceptability of a project across several investment appraisal techniques, at all time, the decision should be based on the NPV criterion. I repeat, when there's a decision to be made using several investment appraisal technique on the acceptability of a project at all time, the decision should be based on the net present value criterion. Why? Because NPV is a technique, is a measure of profitability, is a measure of absolute profitability, and is a technique that is in consonant, that is in line, or that is consistent with the shareholders' equity value, okay? The shareholders' wealth maximization objective. It is expected that a positive NPV will increase the value of the company, and which will invariably maximize the wealth of the owners or enhance the owner's equity value. All right, and that's why NPV is considered to be more reliable relative to the internal rate of return in ranking mutually exclusive projects. So across all other techniques, NPV, internal rate of return, modify internal rate of return, project duration, payback period, adjusted present value, whatever, at all time, whenever you want to make a decision, if examiner is not specific, then your decision should be based on net present value. You are not going to say, oh, the project should be accepted on the basis of net present value. You must state the reason why you prefer NPV over the other. That's what I just mentioned, that NPV is a measure of profitability and is a technique that is consistent with the shareholders' wealth maximization objective. And you know that the primary objective of every company is to maximize the worth of the owners. So if a technique is in line in achieving that objective, then that we consider to be the best of all investment appraisal technique. So that is all the story you need to take into consideration as far as this discussion. You need to take into consideration in relation to NPV as well as the internal rate of return. So let's talk about modified internal rate of return. Let me know before I go into that if you have any question for me. So far, so good. Let me know if you have any question for me before we go to modified internal rate of return. Okay, so let's move on. Now, let's talk about modified internal rate of return. Yes, when there are unconventional cash flows, unconventional cash flows are cash flows that include both positive and negative cash flow together. Say, for example, you have year 1 to 4, year 1, year 2, year 3, year 4. In year 1, the project generates a positive cash flow of 5,000. In year 2, negative cash flow of 3,000. Year 3, positive cash. Year 4, 500. Okay, so these cash flows involve both positive and negative. When you have this kind of a situation, this is called unconventional cash flow. So when there are unconventional cash flows, it is not appropriate to use internal rate of return as a sole decision criterion because it will be conflicting with the NPV decision. As a result, we will not be suitable to appraise a project and will not be consistent with the shareholders' worth maximization objective, because any technique that will not be consistent with NPV, that means that technique is not suitable. All right, it's not suitable because it will be conflicting with the objective of shareholders' wealth maximization. Now, generally, the assumption behind NPV is that the cash flow generated by a project can be reinvested at the company cost of capital. Okay. Meanwhile, the internal rate of return assumes that any cash flow generated by project should be reinvested at internal rate of return. Again, this is an apparent conflict. All right. Internal rate of return is proving stubborn. Okay, telling NPV you can go, you can do, if you like, use cost of capital to discount the cash flow generated by the project. As far as I'm concerned, I'm going to use internal rate of return to discount any projects generated by the project. Sorry, any cash flow generated by a project. Okay, and that is why the modified internal rate of return has been developed in order to correct the anomalies associated with the internal rate of return. The modified internal rate of return will generally allow a decision maker to specify a reinvestment rate that can be used for receipt and payment associated with a project, such that the decision maker can decide whether reinvestment can decide on a reinvestment rate to be used to evaluate the project. All right. So the modified internal rate of return is on the basis of it's on the assumption consistent with the consistent with the NPV, such that the cash flow generated by the project can be reinvested at the company's cost of capital or at the reinvestment rates. All right. So what that simply means is that whenever you want to compute modified internal rate of return, and you are given reinvestment rates as well as the company cost of capital, then of course, for the for the positive cash flows, you are expected to use the reinvestment rates to discount or to calculate your terminal value. Then you use company cost of capital to discount the cash outflows. All right, I will explain to you as we proceed, but just know that for now. Now, how do you compute? How do you compute modified internal rate of return? There are two methods that you can use to calculate modified internal rate of return. Method one, okay, let me put it there. Methods of calculating modified internal rate of return. Like I said, there are two methods. One is terminal method, terminal value. Then two, we have present value, present value method. So each method has 4 procedures. So let's take it one by one. Let me look for a space. Okay. For the terminal value, let me shift to this side. For the terminal value, there are 4 procedures. Step one, let me write that. Step one, whenever you want to compute terminal value, the first step you are going to carry out is to calculate terminal value for all positive cash flows. All right, calculate terminal value for all positive cash flows. Okay. Then step two, calculate, determine the present value of cash outflows. Okay. Then step three, you calculate modified internal rate of return. Okay. Using the formula below. Okay. What is the formula? Okay, I think you have it already. Okay, let me rewrite it. Now, whenever you want to calculate modified internal rate of return using terminal value, all right, so the modified internal rate of return will be computed as DO, that is terminal value, divided by present value of cash outflow, that is DN. All of this raised to power 1 over n, all minus 1. Okay, of course, you're expected to multiply with 100 over 1 because your final answer must be in percentage. So this is the formula that you can use to compute modified internal rate of return using terminal value. Of course, this is the same formula that you have here. Whether you use this or you use this is the same thing. DO is the terminal value. DN is the present value of cash outflow. N is the useful life of the project. Somebody is sending a message. Sir, what is terminal value? The terminal value is just the amount the company will receive if the cash flow is reinvested. For example, if you make a 1,000 naira cash flow, now you want to reinvest this 1,000 naira in the next 5 years. So you need to just like a compounding factor, a compounding value. So including the benefits you are going to earn with it. So for the next 5 years, for example. So the terminal value will be the final year, the cash flow you are going to earn in the next 5 years, including benefits and the capital you have invested. All right. So terminal value is more like that. Okay. Okay, then move on. Yes. So then step 4, you need to accept. You need to decide whether the project should be accepted or not. That's step 4. That is advice. So that's that. Then using the present value method, let me come here. Present value method. Using present value. I want to show you the procedure to carry out. Present value method. All right. So the first step you need to do, if you want to use present value method to calculate modified internal rate of return, the first thing you need to do is to calculate present value of all positive cash flows. Calculate present value of positive cash flows. Step 2, for negative cash flows. Okay. Then step 3, you calculate modified internal rate of return using the formula below. So modified internal rate of return will then be calculated as the present value of cash inflow over present value of cash outflow. All of this raised to power 1 over n multiplied by 1 plus r. All of this minus 1. Let me extend. So all of this minus 1, then you now multiply with 100%. So this is the big for nothing formula that will be given to you on the day of your exam. At the back of your question paper, you are going to have about 7 different formulas. So this particular formula is one of them. But in the question, it's not called present value of cash inflow, present value of cash outflow. Rather, it is called present value. Okay. The present value of cash inflow is the same thing as present value of return phase cash flows. You know, there are 2 phases of a project. The phase when the company is spending money on the project, that's when the company is investing. Okay, that's investment phase cash flow. Then we also have the phase when the company will be reaping the benefits of the project. That is when the company will be the project will be generating cash inflow. All right. So, but I like to use present value of cash inflow and cash outflow since you're already familiar with that. So it's better. Then N is the useful life of the project. R is the cost of capital of the company. All right. So do this. Then step 4 is to advise whether the project should be accepted or not. So that's basically the two methods that you can use to calculate modified internal rate of return. Now, there are decision rules. What are the decision rules for modified internal rate of return? Same way we did for internal rate of return. For independent projects, you accept if modified internal rate of return is greater than the company's cost of capital. If not, you reject. Then for mutually exclusive projects, you accept any projects with a higher modified internal rate of return, provided it is greater than the company cost of capital. But where the modified internal rate of return equates the company cost of capital, the company can either accept or reject the project depending on other qualitative factors. All right. So this is how to calculate modified internal rate of return. Please go through the material so that you can gain more knowledge on that. All right. Especially in the golden book. So there are a lot of examples there. Okay, so let's have a short example just to demonstrate only this modified internal rate of return before we move to the other part. Let me see. Let me see if I can have an example here. I think and there's an example. Okay. Let's solve this illustration number 5. Illustration number 5, just as an example to demonstrate whether you use any of the two methods that you use, whether terminal value or present value method, you are going to get the same answer. So, but in an exam whereby you are asked to compute NPV, you are then asked to calculate modified internal rate of return, it's better to use the second method, which is the present value method. It will be faster. So instead of you to be calculating terminal value, since you've already calculated present value before you get your NPV, just add the NPV plus the present value of cash outflow together. Then you keep it on one side, then you get your present value of cash outflow. You move on from there. So it's very straightforward. Okay, I need somebody to read for us, please. Who will be our caster tonight? Yes, who will help us to read?
Let me do that, sir.
Please go ahead.
Filipino PLC is considering an investment in a project which requires an immediate payment of 15,000 naira, followed by a further investment of 5,400 naira at the end of the first year. The subsequent return phase next cash inflows are expected to rise at the end of the following years. All figures are assumed to be correct. Required, calculate the modified internal rate of return of this project, assuming a reinvestment rate equal to the company's cost of capital of 8%.
All right, thank you very much. Yes, that is the question. The examiner wants you to calculate modified internal rate of return. Certainly, if you are going to have question under modified internal rate of return, examiner will surely tell you that you should use modified internal rate of return. Because if you are given a cash flow like this and you are just told to calculate, advise whether the project should be undertaken, you won't know which of the technique. You can use NPV and move on. All right. You can use internal rate of return and move on. So, but what I'm trying to say in essence is that if you are going to calculate modified internal rate of return, examiner will surely tell you to do that. Other than that, So you have to use NPV. Okay, then. Now, to solve this particular question, what are you supposed to do? Like I said, I can either use terminal value method or I use present value method, and I will get the same answer. But one thing you need to take into consideration is that you need to follow the assumption behind modified internal rate of return, because your objective, your intention is to reinvest. You want to reinvest the cash flow generated by the project. All this cash flow from year 1 to 5, you want to reinvest it. Therefore, we are expected to use the reinvestment rate or the company cost of capital. And I said that if the reinvestment rate and cost of capital is given to you, then you have to use the reinvestment rate, because the modified internal rate of return allows decision maker to specify the reinvestment rates to be used for to discount the future cash flows. All right. So that is for that. So let me stop sharing this and move to the working notes. So the name of the company is Filipino. The name of the company is Filipino PLC. So I will then come here. This is solution to illustration number 5. Solution to illustration 5. Filipino PLC. So examiner is asking us to calculate modified internal rate of return. I would then say calculating modified internal rate of return. Again, please, don't do this on the day of your exam. You have to write it out in full. Modified internal rate of return. Don't go and write MIRR. You may be penalized. Okay. So, like I said, I can decide to use either terminal value or present value method. I'm going to use the two just to demonstrate for you. Either of the two, you are going to get the same answer. So using terminal value, the first step says you should calculate terminal value for all the positive cash flow. You don't calculate terminal value for negative cash flows. It has to be positive cash flows. So I would then say terminal value, calculating terminal value. TV. Just the same way you normally calculate present value, only that when you are calculating terminal value, you are expected to compound the cash flows. You are expected to compound the cash flow, and you don't include year 0 when you are calculating terminal value. You don't include year 0. So the useful life of the project is 5 years. So I can say year 1, year 2, year 3. Let me write that. Year 3, 4, then 5. Cash flows. If you like, you can include description of items, but it's not necessary. All right. So give me the cash flow for year 1. What's the cash flow of year 1?
6,500.
6,500. Here is 6,500. Year 2?
7,750.
7,750. Year 3?
5,750.
Okay. Year 4?
4,750.
4,750. Then year 5 should be
3,750.
3,750. Thank you. So these are the cash flows generated by the project. Our intention, calculating terminal value, our intention is to reinvest the cash flow generated by the project. You want to reinvest it. Therefore, I want to know if I invest this 6,500 at the end of year 1, what am I going to receive in the next 4 years? Because I can only reinvest this 6,500 in the next 4 years. So what am I going to receive in the next 4 years? That is the terminal value. So to get the terminal value, I need to create a column for compounding factor. Instead of discount factor, it will be compounding factor. At 8%. Because examiners told us that the reinvestment rate is equal to the company cost of capital at 8%. Then I will create a column for terminal value. Now, in the compounding factor, the formula for compounding factor is 1 plus r raised to power n minus 1. Okay? N minus 1. So R is the reinvestment rate or cost of capital. So in this case, this will be 1.08, 1.08, 1.08, 1.08, then 1.08. Now, remember what we said, that the cash flow, you want to reinvest the cash flow generated by the project. So the cash flow of 6,500 generated in year 1, how many more years can you reinvest it? So you then go back. The useful life of the project is 5 years. 5 minus 1 will give us 4. Or you can say year 1 is already gone because this project has 5 years life. Year 1 is already gone. Then how many more years can I reinvest the 6,500 that was achieved at the end of year 1? I have 4 additional years. 1, 2, 3, 4. So here will be raised to power 4. Then the cash flow of year 2. This 7,750 occurs at the end of year 2. So year 1 and year 2 is already gone. That means I have year 3, year 4, year 5. So I can reinvest the 7,750 in the net for the next 3 years. Also, the cash flow of year 3 of 5,750 occurs at the end of year 3. Year 3 is already gone. I have 2 more years left. Therefore, I can invest that 5,750 for the next 2 years. The 4,750 occurs at the end of year 4. I have only 1 year left, which I can invest the 4,750 raised to power 1. The 3,750 occurs at the end of year 5. Of course, how many more years can I reinvest it? 0. All right. So at this point, I will then carry my calculator. I bring out your calculator. You start from the compounding factor by saying that 1.08 raised to power 4 equal 1.3 whatever, then multiply whatever you have in your calculator, multiply by 6,500. That's 8,843. The terminal value is 8,843. So that is the terminal value. This terminal value includes both the benefits as well as the capital you have invested. All right. So you can see the person that was asking me the other time, what is terminal value? So the benefit the company has earned on the project plus the amount invested. You invested 6,500 for the next 4 years, and the company is going to earn to a total of 8,843. All right. When you less 65 from that, that means the benefit is around 13 something, 1343. Yeah. So do the same thing for year 2. Starting from the compounding factor, 1.08 raised to power 3 equal multiplied by 7,750. That's
9763.
9763. Here is 9763. You do the same thing for year 3. What do you have there?
6707.
6707. Year 4.
5130.
5130. 5130. Anything raised to power 0 is equal to 1. So the one
Yeah,
of year 5.
375.
Yeah. So add it up. Add it up. This represents the terminal value. What do you have?
34,193.
34,193. That's the terminal value. That's step one. Step two says you should calculate present value of cash outflows. So present value of cash outflows. Okay. So cash flow. You know, when you are calculating present value, you are supposed to discount at 8%, then present value. So in year zero, we have initial outlay. What's our initial outlay? According to the question, you are told that immediate payment of 15,000 naira, followed by a further investment of 5,400 at the end of the first year. So there are two cash outflows. So in year zero, the company invests 15,000 naira. Discount factor at year zero at 8% for year zero is equal to 1. 1 multiplied by 15,000 is 15,000. There's no need for you to come and put this in brackets because you've already said cash outflow. So don't put it in brackets again. Then in year one, we're also told that there will be a further investment of 5,400. So somebody should give to me discount factor at 8% for year one. 0. What? Yes. 1.08 raised to power minus 1. 1.08 raised to power 1 minus equal. That's 0.926.
0.926.
Okay. 0.926 multiplied by 5,400.
5,000.
5,000. So when you add the two together, that's 20,000. So now we have completed step 1 and step 2. Step 3 says we should calculate modified internal rate of return. Therefore, I would then say modified internal rate of return. Since I'm using terminal value, I would then say terminal value divided by present value of cash outflow, all raised to power 1 over n, okay, minus 1. All right, which is equal to DO is the terminal value of 34,193 divided by present value of cash outflow, 20,000. The useful life of the project is 5 years. Therefore, raised to power 1 over 5, or minus 1. Modified internal rate of return will then be equal to, I will then carry my calculator to say 1 divided by 5 is 0.2. Therefore, I can say 34,193, sorry, not 37, 34,193 divided by 20,000 equal, then raised to power 0.2 equal, minus 1 equal, multiplied by 100% equal, that's 11.32. Here is 11.32%. Approximately modified internal rate of return is equal to 11%. Modified internal rate of return is equal to 11%. So examiners say we should calculate the modified internal rate of return of the project. So if you're asked to advise, then you need to compare this with the company cost of capital of 8%, which of course the project is financially viable and should be undertaken. So using terminal value, this is how you are supposed, this is what you are supposed to do. Then let's use the other one, which is the present value method. Okay, using present value method, Okay, using present value method, again, there are 4 procedures. The first procedure, you need to calculate present value of cash inflow. Then step 2, calculate present value of cash outflow. Step 3, calculate modified internal rate of return using the appropriate formula. Then step 4, you advise. So since we have calculated present value of cash outflow, so let's calculate present value of cash inflow and see. All right, PV of cash inflow, or you can say PV of positive cash flows. So create a column for year, cash flow, discount factor at 8%, then the present value. Year 1, year 2, year 3, year 4, year 5. Okay, so here is 6,500, 7,750, 5,750, 4,750, then 3,750. Somebody should give to me discount factor for year 2. This one is 0.926. We calculated previously. Year 2 discount factor at 8%. What do you have? Yes. Are we still together?
0.857.
8,
57.
857. Okay. Year 3. What about year 3?
0.794.
794. Year 4.
0.735.
0.735. 6642, 6642. 0.7. Did you say 735?
Yes, sir.
Okay. Then year 5.
0.681.
681. So let's get the present value. So I've done 2. 3,750 multiplied by 0.681. That's 2,554. There is 2,554. Then 4,750 multiplied by 0.735.
Year 3 is
3491.
4566.
Okay. 4536. So let's
66.
26.
66.
66. Oh, okay. So let's add it together. Let's get the total present value. 1619 plus
23272.
23272. So that's the total present value. We've already calculated present value of cash outflow, present value of cash outflow to be equal to 20,000. Remember, when we use terminal value, we calculated present value of cash outflow, which is this 20,000. So in that regard, I would then say step 3 now, which is to calculate modified internal rate of return equal to the present value of cash inflow divided by present value of cash outflow. All of this raised to power 1 over n multiplied by 1 plus cost of capital, all of this minus 1. Okay, you now multiply everything by 100%. So modified internal rate of return is equal to Present value of cash inflow is 23,272. Present value of cash outflow is 20,000. Raised to power 1/5. N is 5 years. Multiplied by cost of capital is 8%. So 1.08 or minus 1. Okay. So modified internal rate of return will then be equal to, I will just carry my calculator and get the final answer. So carry your calculator, then you say 23,272 divided by 20,000 equal raised to power 0.2. Okay, because 1/5 is 0.2 equal multiply by, oh, there's an error. I didn't do it properly. 23,272 divided by 20,000 equal, then raised to power 0.2 equal
11.32.
multiply by 1.08 equal minus 1. That's 11.32. 11.32%. So whether you use terminal value method or you use present value method, you will get the same answer. So that is for that. That is for that. So let's move on to, yes, so far we have discussed NPV, internal rate of return, areas of conflict between NPV and IRR. Then we just finished discussing modified internal rate of return. So let's move to the next one. I will stop sharing this and go to the main notes. Let me know if you have any question for me before I switch. Any question? Okay, let's move on. So let's talk about, before we talk about discounted payback period, let's go to project duration. I'm not sure there's project duration in this material. There's no project duration. So let's talk about project duration. Okay. In that case, I need to go back to the, let me go back to the working note since it is not here, so that I'll be able to express myself. Let's go back to the working note. So let's talk about project duration. So when we get to capital, when we begin to solve the kind of question we are going to meet on the day of the exam, so there is a particular question that involves a modified internal rate of return. So we are going to do that, so you have additional knowledge on that. So let's talk about project duration now. Project duration. So project duration is just like, is similar to payback period or discounted payback period. So the project duration, let me put it down since it's not in your notes. Project duration, this represents the average time taken to recoup, to recover or recoup the amount invested in a project. It is similar to the normal payback period. It is similar to the normal payback period, except that the cash flows are discounted, okay, to the present value equivalent before calculating the duration of projects. Okay. So to save time, I don't want to talk too much. There are basically two methods of calculating project duration. Let's put it down. Methods of calculating duration. The beauty about this project duration is that when you get to bond valuation and analysis, you are going to calculate, or you are going to learn about bond duration, Macaulay duration, and then modified duration. Okay, so it's the same thing. It's the same thing. Your calculating modified duration is the same thing as project duration, only that here you are using cash flow. In the other one, you are going to be using whatever, it's the same cash flow, but slightly different. Okay. All right. So I said there are basically two methods. There are basically two methods of calculating project duration. I decided to write it out since it's not in your notes, so that you don't say you don't have a note on that. Including one, present value method. Then two, weighted average method. So let's pick it one by one. Present value method. So under the present value method, what are you supposed to do? I will just give you the formats, okay? Using present value method, you are going to create about 5 or 6 columns. You can omit one, so you are going to create about 5 or 6 columns. The first column will be the year, okay? You create a column for year. Now, one thing you need to, okay, I will explain to you later on. I wanted to mention where you have a negative cash flow that you should ignore it. Please remind me so that I don't forget. I need to explain on that. All right. So you have, after this, then you have cash flow, discount factor. Then you have the present value. Then you have the proportion of present value. Then you have the duration. Okay. That's that. So these are 6 columns. So I've omitted one. So I intentionally omitted it because it's not really necessary. So this is, let's say this is A, this is B, this is C, this is D equal to A times C. This is E, this is F. F is equal to A multiplied by E. Okay, put this there. Let's say you have 3 years life. Please, you don't include, I will explain negative cash flow. I will explain later on. So you add up all of that. Okay. So this is the duration. This proportion must be equal to 100%. Total PV okay. Total. So let me explain further. Whenever you want to calculate project duration and you are using present value method, all right? The most important thing you need to do is to calculate, the first step you need to do is to calculate the present value, okay? Present value of the cash flow for each year. You calculate present value of the cash flow of each year. Then step 2, you determine the proportion of the present value to the total present value. How do you determine the proportion? You've already calculated present value for each year, all right, to get the total. So to get the proportion of the PV, you are going to pick the present value of the first year. You divide it with the total present value. Whatever the ratio you get, put it there. You pick the second present value. Present value of the second year divided by the total present value. It will give you the proportion. That's how you are going to do for all. And at the end of the day, the total proportion must be equal to 100%. So to now get the project duration, just multiply the year, the number of year with the proportion you have for each year. So that will give you the duration. You sum up all the duration. So that will give you the duration of the project. Now, that is using the present value method. Using weighted average method. Weighted average method. Okay. Using weighted average method, again, this you can create about 6 columns for this or 5 columns. This first column will be the year, then cash flow, discount factor at whatever percentage, then we have the present value, okay, then you have the weight. All right, say this is A, this is B, this is C, this is D equal to B times C. Then this is E, which is equal to A multiplied by D. A multiplied by D. So, number of years, cash flow for each year, you discount it to have the present value. You add up all the present value. Okay. You add up all the present value. So here is total. Add up, add up. Now to get the project duration will then be equal to the total weight divided by total present value. Total present value. Okay, of course, your final answer must be expressed in years because we said duration. It must be expressed in years. All right, so this is how to calculate project duration. So using the weighted average method, the first thing you need to do is to calculate the present value of cash flow of each year. Then you calculate the weight. You calculate the weight for each year. The weight is computed by multiplying the number of years with the present value for each year. Then step 3, you calculate the project duration using this formula. That's all. That's all. So these are the two methods that you can use to calculate project duration. Notes. Notes. If negative cash flow is given at the beginning of the project, or if negative cash flow is given in year 1, or let me reframe it. Okay. If negative cash flow is given in year 1, it should be ignored. Let me just continue. It should be ignored when calculating duration. However, if the negative cash flow occurs in between years, the negative cash flow will be included when calculating duration. Now, let me explain to you what I mean by this. What I'm trying to say in essence is that if you are given a negative cash flow in year 1, that negative cash flow should not be included whenever you are calculating project duration, which means that you are going to ignore it, move to year 2 where you have positive cash flow. But if negative cash flow, if in the first year you have a positive cash flow, and then in the second year or in the third year you now have a negative cash flow, that negative cash flow should be included. So you only ignore negative cash flow if it occurs in the first year. Other than that, it should be included. For example, this is what I'm trying to say in essence. Say scenario 1, for example, scenario 1. You are given in year 1, year 2, year 3. So in year 1, of course, this is cash flow. Cash flow given in year 1 is 5,000 negative. In year 2, positive cash flow. Year 3, positive cash flow. So when you are calculating project duration, you are going to ignore negative cash flow that occurs in year 1. So you only do for year 2 and year 3. You don't include year 1 because year 1 is negative. Scenario 2. In year 1, This project has 3 years also. In year 1, the cash flow is 2,000 positive. In year 2, 1,500 negative. In year 3, 4,000 positive. So when you are calculating in this scenario number 2, when you are calculating your project duration, since your negative cash flow occurs, the negative cash flow occurs in the middle, not at the beginning, occurs during the course of the project, then it should be included. All the three, both the positive and negative cash flow should be included when calculating the project duration. All right. So irrespective, provided the negative cash flow does not occur in year 1, it should be included in the project. But if it occurs in year 1, the negative cash flow should be ignored. All right. So this is how to calculate project duration. All right. So the decision rule under project duration will be similar to decision rule under payback period. All right. Which of course, for independent projects, you are going to benchmark your project duration with the management predetermined duration. All right. We are going to benchmark it with the management predetermined duration. But yeah, that is for that. And then for mutually exclusive projects, we select any project with a shorter duration. That's it, provided it is equal or less than or shorter than the management predetermined duration. Okay. So that is that as per duration. I've told you duration is just the average time taken to recover the amount invested in a project. Management may want to know how long will it take them to recover the amount invested in a project. That is the duration. Okay. And I told you there are 2 methods of calculating duration, which is present value method and at the same time the weighted average method. And I told you when you want to calculate the project duration using present value method, there are 3 or 4 procedures using present value method. The first procedure is to calculate the present value for each year cash flow. Then step 2, we calculate the proportion of the present value for each year. The proportion of the present value is computed by dividing the present value of each year with the total present value. Then step 3, we calculate the duration by multiplying the number of years with the proportion for each year, and you sum your answers. That's it. That is how to calculate project duration using the present value method. Then using the weighted average method, there are 3 procedures. The first procedure is to calculate the present value of each year. Then step 2, you calculate the weighted average of each year. Okay, you calculate the weighted average of each by multiplying the number of years with the total present value. All right, that's step 2. Then step 3, you calculate the project duration by dividing the total weights with the total present value. That's all you need to do. And I also mentioned to you clearly that when calculating project duration, negative cash flow that occurs in year 1 should be ignored. All right, negative cash flow that occurs in year 1 should be ignored. But if negative cash flow occur in between years, that is in any other years other than year 1, then it should be included. So it should be included. All right. So that is how to calculate project duration. Let me see if I can have an example to demonstrate this. So let's have a short illustration to explain this, to demonstrate our understanding on the project duration calculation. Let me just say, okay. So let's use this short example to demonstrate that. A project with an initial outlay of 200,000 naira is expected to generate the following cash inflows for the next 6 years. Okay. The cost of capital is 10%. Required, calculate the project duration. So you will notice that In year one, we have a negative cash flow of 40,000. From year 2 to year 6, we have a positive cash flows. So examiner was very specific that we should calculate project duration. So in calculating project duration, I can either use present value method or I use weighted average method. Whichever one I use, I'm going to get the same answer. Therefore, let's demonstrate the two and see what we are going to get. Okay. Now, using the, I started with weighted average method. So using weighted average method, ordinarily, you are not expected to include negative cash flow because in year one, there's a negative cash flow of 40,000. So you ignore it. It should not be part of your duration calculation. And that's why if you look at the cash flow that you have here, the one of year one is ignored. It's not part of it. Therefore, you list all the cash flows. Determine your cost of capital as given to us is 10% in the question. So you get the discount factor at 10% for year 2, year 3, year 4, year 5, and then year 6. The next thing we need to do is to calculate the present value for each year. So just multiply the cash flow with the discount factor. We got this, okay? Now, the next thing we need to do is to determine the weights. How do you get the weights? Just multiply number of years with the total present value you calculate for each year. So, and we got this, all right? Therefore, to get the project duration, you divide the total weights with the total present value, okay? And that's what gave us, let me see, 307,650. Let me see. Yeah, 1,209,640 divided by 307. Sorry about that. I did. He did not tell me. I've been asking. Is anybody talking to me? Nobody answered.
We answered.
Because we can't hear you now.
Sorry about. So I've been talking to myself since. Yeah, sorry about that. Okay, let me take it again. All right. So, like I was saying, so this one's supposed to be 3.93 years, because when you divide 1,209,640 over 307,650, it should give you 3.93 years. All right. Now, alternatively, I can decide to use present value method. So using present value method, there are 3 procedures. The first procedure is to calculate present value of each year. Okay. The procedure is to calculate the proportion of the present value for each year. How do I do this? I'll just it's network that is causing this. Let me reshare. Okay. So, like I was trying to say, now, for example, I can then say the present value of the first year, which is 24,780, divided by the total present value of 307,650, equal, then multiply by 100%, equal, that's 8.05, rounding to 1 decimal place. That will give us a 8.1%. That's how we arrive at this 8.1%. I can, for example, I can do this for the second one. So the second present value is 90,120 divided by total present value of 307,650, equal, then multiply by 100, equal, that's 29.29, rounding to 1 decimal place, that's 21.3. That's how I got all the proportion of the present value. Then the third procedure is to calculate the project duration. How do I get I think we are going to, after this duration, maybe we'll end the class for today. My network is frustrating. Okay, so let me just complete this. So the third procedure is to get the duration. How do you get the duration? Just multiply the number of years with the proportion. For example, I can say in year 2, the duration of year 2, this is, I will say 2 multiplied by the proportion, which is 0.81, 0.081, 0.081 equal. That's what gives us 0.162 to the two decimal place. That's 0.16. Do for the next one. 3 multiplied by the proportion of 0.0293. Okay. 293 equal. Okay, that's 0.879 into 2 decimal place 0.88. That's how I got all the numbers. So you had all the duration together, that's 3.93. So the project duration is 3.93. So you will notice that, of course, I've already explained that I did not include negative cash flow that occurs in year 1 when calculating the project duration. So this is how to calculate project duration. Like I mentioned to you, when you get to bond valuation, Mr. Shuaju will teach you how to calculate modified duration as well as the Macaulay duration. So calculating modified duration is the same thing, the same format that you have here is the same thing, the same way you are going to calculate your modified duration when you get the bond duration. All right. Okay. So that is that as per duration. So let me just see if this thing will allow me again. Now, the next technique we should discuss is discounted payback period. But I would like to explain payback period before we talk about discounted payback period. So other techniques under the discounted cash flows, like profitability index, benefit cost ratio. We are going to discuss it when we get to capital rationing. Then adjusted present value is a scope on its own. So immediately after we are done with capital budgeting, then the next thing we are going to discuss is adjusted present value. All right, because it's more technical than the NPV. All right, so let's move on. Let's go back to non-discounted cash flow method. Under the non-discounted cash flow method, we said there are 2 techniques, including the payback period as well as the accounting rate of return. Yes, talk to me.
No, sorry to take you back. I think I missed the weighted average method. Now when the network started, so I didn't get the explanation around that.
The weighted average method. Yes.
For the duration.
For the duration, right?
Yes.
I said, of course, using weighted average method, all you need to do is there are 3 procedures. The first procedure is to calculate present value for each year. You calculate present value for each year. Just multiply the cash flow with the discount factor. So that will give you present value for each year. Then you get the weights. You determine the weights. How do you determine the weights? To get the weights, you multiply number of years with the present value for each year. For example, 2 multiplied by 24,780 will give us 49,780. 3 multiplied by 9120 will give us 270,360. So you add up the total present value. you add up the total weight, then you calculate your project duration. And I said that whether you use weighted average method or you use the present value method, you will get the same answer. In the exam, you are not expected to use the two. Just use anyone that is more convenient for you and you move on. Examiner will never ask you to use weighted average or to use present value. No. So you are at liberty to use anyone that is more convenient for you. Okay, Bumi, is it clear?
Yes, sir. Thank you.
You are welcome. Okay, so yes. Let's talk about the non-discounted cash flow. Let me just use this material to explain everything. So the non-discounted cash flow method, I mentioned earlier today that there are two techniques under non-discounted cash flow method. One is the payback period, then two is the accounting rate of return. What do you understand by payback period? The payback period is the period usually expressed in years in which it takes cash inflow to equate cash outflow in capital investments. The payback period is a measure of liquidity. That is, how quick, how soon can a company recover or recoup the amount invested in a project. Say, for example, you have an initial investment of 500 million naira, and this project will last for 5 years. Okay, and then say, for example, it's expected that the project will generate annual cash flows of 200 million. All right, annual cash flow of 200 million. So you want to know how long will it take you to recover the amount you have invested. In this particular scenario, the amount invested is 500 million. Okay, so all you need to do is because this is a constant cash inflow, so all you need to do is to divide the cash outflow over the constant cash inflow. That is 500 million divided by 200 million. That will be 2.5 years. So that means the company will recover the 500 million within the next 3 years. That is 2.5 years. All right. So that is what payback period is all about. The number of years it will take the company to recover the amount invested in a project. That is payback period. And I also mentioned payback period is a measure of liquidity. That is, how quick, how soon can the company recover the amount invested in a project? Okay. Now, one thing about payback period is that every other techniques, apart from the accounting rate of return, requires cash flow. Okay. Every other techniques, except accounting rate of return, uses cash flows. Therefore, if accounting profit is given to you, you need to convert it to cash flow before putting your payback period or any other techniques apart from accounting rate of return, because it's only the accounting rate of return that makes use of accounting profit or loss. So, however, how do you then convert accounting profit to cash flow? To convert accounting profit to cash flow, just you calculate your depreciation, then you add it to the accounting profit or loss to get your cash flow. That is, cash flow is equal to accounting profit or loss plus depreciation. So that is for that. Of course, all those advantages and disadvantages is good to know. Just read it through. It's good to know, but examiner cannot be asking you at this level. Now, what's the decision rule as far as payback period is concerned? For independent projects, except if a payback is shorter or equal to management predetermined payback period. One thing about the non-discounted cash flow method is that whatever you have calculated, you need to benchmark it against the management predetermined figure. All right. For payback period, you need to benchmark your calculated payback period with management predetermined payback period. You don't benchmark your payback period with the useful life of a project. You don't do that. It has to be benchmarked against the management predetermined or intended payback period. All right. So for independent projects, if your calculated payback period is shorter or equal to management targeted payback period, then the project is financially viable and should be undertaken. If not, the project should not be accepted. For mutually exclusive projects, you accept any project with a shorter payback period, provided it is shorter or equal to management predetermined payback period. So that is what you need to do under the mutually exclusive projects. All right. Now, there's one key important thing which I've mentioned briefly. When you are calculating your payback period, in determining the financial viability of a project using payback period, the calculated payback period should be benchmarked against the management targeted payback period for the acceptability of the project. This means that if the predetermined payback period is not available or provided in the question, there will be no basis for the acceptability of the project. At times, the reason why I have to put this caption is the fact that at times, examiner may want you to use payback period to appraise the project, and your examiner may ask you whether the project should be accepted or not. If you are not given management predetermined payback period, there will be no basis for the acceptability of the project, because you need to benchmark. How do you, when we calculated NPV, we said that if the project produces a positive NPV, then it should be accepted. We calculated internal rate of return. We said that the calculated internal rate of return will be benchmarked against the company cost of capital. Provided the IRR is greater than the company cost of capital, the project is financially viable. The same thing with payback period. The payback period, your calculated payback period should be benchmarked against the management intended payback period. So provided your calculated payback period is shorter than the management intended payback period or equal to the management intended payback period, then the project is financially viable. What I'm now saying here is the fact that at times, examiner will not give to you the targeted payback period. Examiner will not give to you the targeted or predetermined payback period, and the examiner may be asking you whether the project should be accepted or not. What I'm now saying is that there is no base. Once you are not given the management targeted payback period, there will be no basis, because you can't benchmark against you don't use useful life of a project as the basis for acceptability. No, the basis of acceptability is the management targeted payback, because as a management, I may want to know how long will it take me to recoup the amount I've invested in the project. Okay, for me to be able to accept any project, this project should be able to pay me back my invested capital within 3 years, or within 5 years, or within 2 years. That is what is called management targeted payback period. So I will then go ahead to analyze, to appraise the project by calculating the payback period. If the project payback period is shorter than the 2 years that I've intended to recoup the money I've invested, that means the project is financially viable. But if the project payback period is higher than that 2 years, that means it is not financially viable. So this is what I'm trying to say by putting those statements there, because the examiner will surely try you to want to know your understanding. All right. So that is for that. Now, how do you calculate payback period? How do you calculate payback period? There are 2 ways you can calculate your payback period depending on the nature of the cash inflows. If you are given a constant cash inflows, then payback period is cash outflow, is the ratio of cash outflow to constant cash inflow. Like I mentioned the other time in my hypothetical figures that I provided, where we have 500 million initial outlay, then cash inflow for the next 5 years of 200 million. In this case now, if I want to calculate my payback period because my cash inflow of 200 million is constant, I would then say my cash outflow is 500 million divided by constant cash inflow of 200 million. So this will be equal to 2.5 years. Okay, so you only use this formula where where you have constant cash inflow, This simply means that with this figure, it means that this project will pay back within the next 3 years. So all I need to do now is to compare the calculated payback period of 2.5 years with the management predetermined payback period. And that's what I need to do. All right. So under where you are given constant cash inflow, this is the formula you are expected to use. But where you have irregular or non-constant cash inflow, all right, what do I mean by irregular? The cash flows you are given for each year are different, okay? If the cash flow you are given for each year are different, then in that case, you cannot use the formula of step one, the first one. You can't use the first method. You can't use formula. Rather, you are supposed to use the table or the tabular method. How do you use the tabular method? Of course, first thing first, you list out the cash flow for the respective years. All right. Then, of course, you create a column for the balance, okay, at the end of each year. So at year 0, balance still remain 100,000. As I'm moving to this following year, I would then say 100,000 minus 40,000 for the first year. I have a balance of 60,000 at the end of year 1, which means that this company has recovered 40,000 naira. There is a balance of 60,000 naira to be recovered. Okay, then I'll move to the next one. The following year, the cash inflow is 70,000. Meanwhile, I have outstanding balance of 60,000. Where the outstanding balance is less than the next cash inflow, you put a dash, then you compute your payback period. Therefore, I would then say I've recovered only for 1 year. I would then say payback period is equal to the 1 year that I've recovered plus the outstanding balance of 60,000 divided by the next cash inflow of 70,000. This is what gave 1.9 years. Okay, this means that this project will pay back within the next 2 years. Okay, the project will pay back within the next 2 years. So this is how to calculate payback period where you have irregular cash inflows. Let's have an example to this effect. Okay. It's almost okay. Let's quickly run through this. Africana Limited is considering a project that requires a cash outlay of 250,000 naira and generates a net cash flow of 100,000 naira per year for the next 4 years. However, the management of the company has set the maximum acceptable period of 2.5 years for the project to recover the initial investment. This 2.5 years represent the management predetermined payback period required. Calculate the project payback period and advise whether it should be accepted or not. Solution. Okay. Since this is a constant cash inflow, because the cash flow given to us, we are told that the project will generate 100,000 naira per year for the next 4 years. So this is a constant cash inflow. The cash outflow is 250,000. So you cannot, instead of using tabular method will waste your time since you have a constant cash inflow. Therefore, payback period will then be equal to the ratio of cash outflow to constant cash inflow. All right, using the formula here, 250 is the initial outlay. The cash inflow is 100,000. So this project will pay back within the next 2.5 years. So the project payback period is 2.5 years. Since management predetermined payback period is 2.5 years, according to the question, examiner told us that the management of the company has set the minimum acceptable period of 2.5 years for the project to recover the initial investment of 250,000 naira. So what that means is that the project is financially viable because the project is expected, the calculated payback period is equal to the management predetermined payback period. Then the project should be accepted. That's what you need to do. That's what you need to do. Let's briefly have another example. Okay. In this other example number 2, this one has to do with mutually exclusive projects. Okay, let me see. Let's quickly run through this. Okay. Okay. Let's just talk about the accounting rate of return. So we are going to have a better illustration to discuss it. Okay, so that I don't rush you. Let's talk about accounting rate of return. Okay.
Sir, please, it's 11 o'clock already.
Is that diamond? I
It's
usually
no.
no. Okay.
I could
Class, do you want to,
paper.
Wumi, do you want us to end the class? I know he's
Ah,
suggesting it's already
let me
11
have
o'clock.
time paper, and we are going to work tomorrow.
Oh, it's okay then. So on that note, let's call it a day. All right. That's okay. Thank you, everyone. So
Thank you, sir.
in our next class, we are going to continue from here by the grace of God. Thank you, everyone. I will see you next time by the grace of God. Good night.
Thank
Good
you.
night, sir.
Good night.
Nice.